Welcome to another Coffee Chat. I'm Scott Gwatney. Today I'm joined by Christian Clausen, our certified financial planner here at Burns Estate Planning and Wealth Advisors. Welcome, Christian.
Thank you.
Good to have you.
Yeah.
Today we're going to talk about Roths, Roth conversions, Roth contributions, and really the big question is what's the difference between the two of those?
Yeah. So contribution, that's something that, as part of your earned income, you have the ability to put in, for 2022, it's $6,000 a year. If you're over 50, then you can do a catch up, so you can add another $1,000. Well, we got a little benefit between 2022 and 2023, so to add another $500 to that. So if you're under 50, you can do $6,500, and then you can do $7,500 if you're over 50. But that's the limit. Like, you're not allowed to do any more contribution other than that. Gotcha. But inside of a 401k, you also have some Roth, availability, right, like inside of there. The limits there are much higher, and that's right, like one of the benefit for, at least from a contribution standpoint.
Right, and that's what I've always advised clients. Always check with HR, because sometimes you'll just think that only thing that they offer is a regular, traditional 401k contribution, when actually there's a Roth option as well. So just something to check with, HR next time you're filling out paperwork, or towards the end of the year, maybe annual re-enrollments are coming up, time to, maybe check into that and see if that's an option for you as well.
Yeah, absolutely. And then the other thing of like with Roths or conversions. So conversions is something that's not a contribution, but it's if you have an old IRA, an old 401k with a lot of pre-tax money in it, you have the ability then any given year to take a portion of that and move it over to your Roth. But you have to remember, when you do that, you have to pay some taxes on that conversion. So on a conversion, there's no limits. So you can do 50,000, 100,000, a million if you have that much in a pre-tax or a traditional IRA. However, you have to remember that the amount that you move over or convert over to the Roth, you're going to have to pay taxes on that.
Right. So that kind of goes right into the next question is, what's the downside? And that seems like you said, adding that extra earned income to your current salary or you and your spouse's salary, it seems like that could be a potential downside. Yeah,
right. So what if you and your wife, you or your spouse, made $100,000, and then you decided, hey, we want to do a conversion for $100,000. Well, in the IRS's eyes, it looked like you made $200,000. And it may bump you up in a higher tax bracket.
Right.
So you have to be very careful, and you have to do a lot of calculation. It's not just a willy-nilly. You just want to, take over, your IRA money and just move it into a Roth and say, hey, I don't have to pay any taxes anymore on this Roth account.
Right.
Well, you might want to pay attention. If you don't, your CPA or the IRS will tell you.
Yeah. And that's something that I know, you bring a good point that we sit with our clients and ask them is not only your salary, not only this Roth conversion, are there any other rental incomes? How are those, royalties? How are other incomes, Social Securities? It's not as simple, hey, we just want to move this over and pay the taxes on it. We want to make sure from a tax standpoint, what implications elsewhere does it have for our clients as well? So, you make a good point of some potential, not downsides, but maybe some precautionary measures that need to be taken to kind of get that conversion taken care of.
Yeah, another thing you want to think about is like, well, what if I'm retiring next year? Should we convert this year? Well, think about it. If you retire, you're not going to have that earned income. So if you and your spouse are making $100,000 this year, but then you're not having any earned income next year, well, why not do the conversion next year instead of this year? And then you have the ability to convert more. You can potentially do it in a lower tax bracket. If you're making $100,000 a year, or if it's 150, 200,000 a year, you're going to be somewhere in a 22 to 24% tax bracket. Well, next year, you're not having that earned income. Now you can potentially convert in a 10 or a 12% tax bracket instead. Right. So there's a lot of different timings we have to remember.
Yep.
And one of the reasons why we look at, doing conversions is if you have a traditional IRA, we have to worry about requirement and distribution.
Right.
So when you turn 72, you're going to have to take some of the money. IRS forces you to take it out. And, typically somewhere between 2.7, 2.8% the first year, and then it just continues to increase whether you want it or not. Well, the benefit of doing the Roth conversion is that we don't have an RMD age on this. So now we just have to, we do it. We pay a little bit more taxes up front. However, on the, down the road, and we need some money, and we take it from the Roth.
Right.
It's tax free. It's
Right.
grown tax free this entire time.
Yeah. No, that's potentially, a positive. You brought up a good point there, though. If you're still working this year, we're retiring this year or next year, when do we do one? Because I know our clients that are already retired, and maybe that's not a concern. They've been retired for a year or two, and we know we have set incomes of pensions, Social Security. It's time frame wise between, now and, potentially 2025 when the Trump tax cuts, I tell everyone, are going to change. So is it better to do them now? I think our consensus is we know we're in the lowest tax bracket we're probably going to be in. But from that standpoint, how do we factor timing that in? Because we don't know at this point what beyond 25 looks like from a tax perspective. But I think we kind of agree that they're probably not going to go down from here. They're probably going to go up no matter who's in office after 24.
Yeah, no, absolutely. And we just have to remember that, we got another 2 or 3 years that we feel like we want to take advantage of this. But we also have to think about what is the tax bracket we're going to be in when we retire. If you right now you're working in a 22 and 24% tax bracket, but for a fact that when you retire, you're only going to be in a 12% tax bracket.
Right.
Does it make sense to do the conversion? So, Roth is wonderful. And once you've done it, you never pay taxes again. That is phenomenal. However, why convert in a 22 when you're going to live in a 12% tax bracket for the rest of your life potentially? Right. So it's not for everybody. There is a lot of benefits, but you want to talk to somebody before you do it. 75, 80% of the time it makes sense, but pay attention.
You bring up a good point because, I was going to wrap up with the question of, we always get which one's better for me from a client, which one should I do? And from a planning perspective, and of course this is your area, but I think it makes sense to sit down with someone, sit down with us and say, okay, which one's best? Is it a combination? Is it one or the other, or maybe neither? Depending on the situation, I think, we can make sense, but it's more client specific kind of than ever to make it, which one's going to be the most positive impact for each client.
Yeah. And in most cases, it doesn't make sense to do all or nothing deal.
Right.
People think it has to be, it's black or white. No, it's something about, maybe we can take a portion of it and convert. Maybe we just do 20, 30,000 a year to do, the conversion. Maybe take a third of the IRA and do the conversion. Everybody's unique, and so that's kind of how we have to plan it.
Yep. No, I agree. So, when it comes time to do a Roth, I guess the consensus is, give us a call, sit down with us. More than happy to sit down and look at each person's personal situation and make sure we make the, most educated decision we can.
Absolutely.
All right. Well, thanks, Christian, for being here today, and thank y'all for tuning in.
I was going to say Canada.